Structure your money, stabilize your life. Welcome to Kelly Sharing. I'm Kelly, sharing capital and powerful insights on money.
Let me start with the real scenario. Let's go back to the year 2000, the peak of the dot-com bubble. Every headline was saying, technology is changing the world. This is a new era. Long-term investing always wins. I entered the market right at that moment. He invested years of saving, not for speculation, not for short-term trading. He told himself, I'm a long-term investor. He believed he was being rational. Then the market started falling, negative 10%. He thought, normal volatility, negative 20%. He felt uneasy, but he held on, negative 30%. A third of his portfolio was gone. He began checking prices every day. He couldn't sleep. He started doubting himself. Then it kept failing. Negative 40%, negative 50%. Half his assets were wiped out. At that moment, he stopped thinking about long term. He just wanted to stop the pain, so he sold. A few years later, the market slowly recovered. 7 years later, the index returned to its original level. The long-term trend was still upward, but he was no longer in the market. So here's the question. Was long-term investing long? Historical data tells us the long-term trend is indeed upward. Then why did he fail? If we only look at the outcome, it seems like he made a mistake. But we only look at the data. The long-term trend clearly goes up. Now the issue becomes more complicated. Maybe the real problem isn't the market. Maybe it's this. What do we really mean by long-term? So let's take a step back. Let's clarify the most basic question first. What exactly do people mean when they say long-term investing? Part 1. The long-term trend is real. What is the S&P 500? We just talked about the person who entered the market at the peak in the year 2000. Now let's take a step back. Let's clarify a fundamental question. What do people really mean when they say long-term investing? When most people talk about long-term investing, they are usually referring to one index, the S&P 500. What is it? It is a stock market index composed of 500 large public traded companies in the United States. These companies span across technology, healthcare, consumer goods, finance, industrial, and more. Simply put, it represents the collective earning power of large U.S. corporations. When you invest in it, you are not betting on a single company. You are investing in the core productive engines of the U.S. economy. This is why so many people believe long-term investing always wins. Because if you believe the U.S. economy will grow over time, corporations will continue to generate profits, and productivity will keep improving, then logically speaking, the index should rise over the long term. That is the fundamental assumptions behind long-term investing. But does historical data actually support this assumption? Let's look at the long-term chart. From 1928 to today, nearly a century of data. If you zoom out far enough, the trend is clearly upward. It has survived the Great Depressions, World War II, the oil crisis, the dot-com bubble, the global financial crisis, the pandemic, and yet it continues to rise. This is important because it shows us that long-term growth is not a myth. It's the result of economic productivity. Now let's talk about returns. Historically, the S&P 500 has delivered an average annual return of about 8% to 10%, including dividends reinvested. What does that mean? If you stay invested long enough, compounding begins to work in your favor. That is the statistical foundations of long-term investing. Not emotions, not slogans, but historical statistics. But here's the problem. An upward trend does not mean a smooth journey. If you zoom out, it looks like a steady upward line. But if you zoom in, you will see a violent volatility, sharp rallies, severe crashes, deep drawdowns. In other words, the long-term trend is a macro outcome, but the lived experience of investing is micro-level volatility. Those are two very different experiences. And the gap between those two perspectives is exactly why so many people misunderstand the phrase, long-term investing always wins. So next, let's break down what actually happens during those volatile periods in between. Part 2, holding periods versus probability of winning. We just reviewed 3 major historical cycles. the 2000 dot-com bubble, the 2008 global financial crisis, the 2020 pandemic crash. Each decline was severe, and at the time, each one felt like the end of the world. But there's one fact we have to acknowledge. The market eventually recovered every time. So here's the key question. If markets always recover in the long run, does that mean long-term investing really is guaranteed? Let's look at the data. Number 1, lowering return data. Historical lowering return data of S&P 500 shows if you hold for just 1 year, the probability of a negative return is about 25% to 30%. In other words, roughly once every 3 to 4 years, you can expect a losing year. That's normal. But when you extend the time horizon, at 5 years, the probability of a positive return exceeds 80%. At 10 years, the probability approaches 90%. At 20 years, historically, it has been close to 100%. Notice the trend. The longer the holding period, the lower the probability of loss. This is the statistical foundations of long-term investing. It's not emotion, it's probability. Number 2, why does time work? Because time smooths volatility. In short terms, markets are driven by fear, liquidity conditions, emotion, policy shocks, but over the long term, corporate earnings, economic growth, and profitability gains become the dominant forces. That's why the long-term trend is upward. At this point, many people might say, does this prove long-term investing always wins? Here's the problem. Statistical profitability is not the same as individual outcome. These are two very different things. Number 3, statistical win rate versus real-life experience. The data tells you if you hold for 10 years, you are very likely to make money. But in reality, very few people truly stay invested for a full uninterrupted 10 years. Why? Because during those 10 years, you may experience 30% drawdowns, 40% panic, relentless negative headlines, collective pessimism around you, and life doesn't pause for 10 years. You might change jobs, have children, buy a house, support aging parents. Now imagine the market crashes during one of those moments. You will be forced to sell. If you assess in year 7, the 10-year win rate statistic means nothing to you. This is the key logic. Long-term investing increases probability, but it does not eliminate path risk. Path risk means will you be forced to assess before reaching the long term. Number 4, the behavioral finance reality. Long-term studies consistently show that the average investor's actual return is typically lower than the index return. Not because markets don't rise long-term, but because investors more in and out during volatility, buying near highs, selling near lows. This isn't about intelligence. It's about human nature. The human brain is weird to avoid loss. When portfolios decline continuously, emotion overwhelms rationality. So the real question is not, can long-term investing make money? The real question is, can you survive long enough to benefit from it? Number 5, logical summary. Let's connect everything. The long-term trend is upward. A macro fact. The longer you hold, the higher the probability of gain. A statistical fact, but the path is highly volatile. An experiential fact, most people cannot tolerate path risk. A behavioral fact, so long-term investing is not a myth, but it has conditions. And that condition is not prediction skill, not stock picking skill. It is structural resilience. Next, we are going to talk about the most overlooked element, structure. Number 3, the 3 true preconditions for long-term investing. Let's make the logic completely clear. Long-term investing is not a myth, but it does not automatically work. It has prerequisites. Without these conditions, the statistical advantage of long-term has no meaning for you. I summarize them into 3 key principles. First conditions, you cannot be forced to sell. This is the most important one. The first requirement of long-term investing is that you must be able not to sell. It sounds simple, but in reality, it is extremely difficult. Why? Because life is dynamic. If you don't have 6 to 12 months of emergency saving, stable cash flow, proper risk insulation, Then, when the market crashes, it may not be a question of whether you want to sell. It becomes a question of whether you must sell. This is called liquidity risk. Many people in 2008 didn't sell out of fear. They sold because of job loss, mortgage pressures, cash flow breakdown. In those moments, long-term investing theory doesn't help. So the first condition is not about predicting markets. It's about having a stable cash flow structure. Second condition, psychological releasing. The data tells you that markets rise in the long term, but the data does not tell you how many 30% drawdowns you must emotionally endure along the way. Historically, U.S. market experienced a 20% plus corrections every 5 to 7 years on average. Drawdowns of 30% to 50% have occurred multiple times over decades. Now ask yourself, if the market drops 40% tomorrow, will you sleep well at night? Would you A. Buy more, B. Hold steady, C. Reduce exposure, D. Sell everything? If your answer is not A or B, then your belief in long-term investing may not exist in theory. Long-term investing is not a knowledge problem. It is an emotional regulation problem. And emotional regulation depends on whether your structure gives you psychological safety. Third condition, a sufficient time horizon. One of the most overlooked aspects is that time itself is an asset. If you begin investing at age 25, you may have 30 years ahead of you. Volatility becomes your ally. But if you are 55, planning to retire in 5 years, and the market drops 40%, you may not have time to wait for a 7-year recovery. This is called time mismatch risk. Long-term investing only works when your investment horizon exceeds the market cycle. Otherwise, statistical probability does not equal real-life outcome. Let's connect everything. Markets trend upward over the long run, and economic reality. The longer you hold, the higher your probability of success. A statistical reality, but the path is volatile. A lived reality. The three true conditions are: your cash flow doesn't force you to sell. Your emotions don't force you to sell. Your time horizons allows recovery. Remove any one of them, and long-term investing can fail. That's what 90% of people misunderstand. They hear long-term, but ignore the prerequisites. Many people think they are investing. In reality, they are simply buying assets. Real investing isn't managing your structure. Now we have seen the full picture. Market trends upward. That's fact. Longer holding increases win probability. That's statistic. But the path is volatile. That's reality. Most people can't survive the cycle. That's human nature. So the real formula of long-term investing is simple. Time times discipline times structure. All three are required. Time is the engine of compounding. Without efficient time, even great assets cannot combine. But time only works if you remain in the market. If you access early, time becomes irrelevant. Discipline means not chasing when markets surge, not panicking when markets fall, following a plan instead of emotions. Many understand compounding, but fail at disciplines because emotion magnifies during volatility. Structure is the most overlooked piece. It includes emergency reserves, stable income stream, career risk diversification, asset allocation balance, risk insulation mechanisms. Structure serves one purpose: to allow you to remain still during the worst years. The market does not reward the smartest. It does not reward the best forecasters. It rewards those who can withstand volatility, those who can endure 3 stagnant years, those who can tolerate 30% drawdowns. This is not intellectual advantage. It's a structural advantage. Long-term investing is not buy and automatically win. It is having the ability not to access at the worst possible time. Because once you access at the bottom, time and compounding no longer belong to you. Many people understand the theory, but they never build the structure. And in the end, results are determined not by theory, but by your ability to endure cycles. Long-term investing is not a slogan. It is a structural requirement. Time magnifies everything. It magnifies strengths, and it magnifies fragility. The question is not, will markets rise? The question is, can you wait when they don't? Do you remember the investor who sold in the year 2000? He didn't misunderstand long-term investing. He simply wasn't prepared to endure what long-term truly requires. At this point, we have taken a simple slogan and brought it down into a real logic. Long-term investing is not a myth, but it's not a guarantee either. It's a game of probability, and probability only works for those who make it to finish line. The real question has never been, will the market go up? History has already shown us the long-term trend is upward. The real question is this, when markets don't go up, when your portfolio is down 30%, 40%, or even 50%, can you still remain in the game? If you can, time becomes your ally. If you can't, time becomes irrelevant. So the next time you hear someone say, long-term investing always wins, maybe ask yourself one more question. Is my structure strong enough to survive the cycle? If today's video gave you something to think about, I would love you to do 3 things. Like this video, leave a comment below, and tell me, if market drops 40% tomorrow, what would you do? A. Buy more. B. Hold steady. C. Reduce exposure. D. Sell everything. I genuinely want to see your honest answer. And if you haven't subscribed yet, make sure to subscribe. I will continue breaking down investing, risk management, and asset allocation using data, logic, and structural thinking. If you want to go deeper into the 4-layer financial structure framework, why high-income earners often carry hidden structural risks, why the biggest risk for high-income software engineers isn't layoff, you can check out my previous video. I have covered these topics in detail. Time does not reward impulsiveness. Time rewards structures. In the next video, I will continue breaking down complex financial ideas into clear, practical thinking. Thank you for staying until the end. I will see you in the next one. Bye!